Hi everyone, welcome to another episode with the Treasury Girl. In the last two episodes, we spoke about Treasury bills, the history, how it is being auctioned, and how it is being sold, like the market for Treasury bills, right? And in this episode, we'll be speaking about bonds. A bond is an instrument used by government or companies to borrow money from the public. So the public is going to lend them money, they'll now give you interest or coupon, and at maturity, they'll give you back your money. That's the simplest definition for bond. Now, what is the history of this bond? For centuries, governments have relied on bonds to raise money, and the idea is much older than people realize. The earliest versions appeared in medieval Europe around the 1100s, when powerful Italian city-states such as Venice and Florence needed to finance expensive military campaigns. War was expensive, and taxes alone could not cover the costs. So this government turned to unusual solutions. They required wealthy citizens to lend money to the government, and in return, they promised to pay them interest every year. By the 1600s, the concept had evolved widely into the Dutch Republic. The Dutch were global traders, and they began issuing bonds to the public, not just to the wealthy elite. Ordinary merchants and individuals purchased bonds. British advanced the system again in the 1700s. Faced with massive wartime expenses, especially during the long and costly Napoleonic Wars, the British government leaned heavily on bonds to fund the military operations. A turning point came in 1693 when the newly founded Bank of England issued the first formal government bond to raise money for a war against France. In Nigeria, the journey began in 1946. The British colonial government needed money to fund its 10-year development plan after World War II. To raise these funds, it issued Nigeria's first government-registered stock, valued at 300,000 euros and paying an interest rate of 3%. Since independence in 1960, the responsibility of issuing bonds moved to the Central Bank of Nigeria, CBN. Most buyers were large institutions such as CBN and insurance companies. And because these investors simply held the bond to maturity, there was no active secondary market to trade the bonds at. By the late 1990s, the Nigerian debt had become largely fragmented and poorly managed across different government offices. To resolve this, the government created the Debt Management Office DMO in 2000, a turning point often described as the beginning of the Nigerian bond market. The DMO introduced structure, transparency, and a predictable issuance calendar, and in 2003, it issued the first modern federal government of Nigeria bond. In recent years, Nigeria has also introduced different bond products to attract investors. This includes the Sukuk bonds, the green bonds, the Euro bonds, the corporate bonds, and the federal government savings bond. Now, moving to the features of the federal government bond, the tenure is usually between 2 years to 30 years. The coupon is paid biannually, that is twice in a year. It is usually considered risk-free in Nigeria, and it is mostly held by pension funds, banks, insurance firms, and other financial institutions. And that'll be it for this episode. In the next episode, we'll be looking at how bond insurance works, like how it is being auctioned. And I'll see you in the next episode. Bye.